Welcome to the 40 Finance channel, everybody. My name's Jeff Beers, and in this video, I'm going to look at 5 beaten down stocks to add to your watch list. One of the best investing strategies you can do is to buy low and sell high. So today we're looking for quality companies that may be on the dip in a booming market and try to get in a place where we can make some profits down the line. Let's jump right in. First on our list today is the Raytheon Company, which is a defense company as far as selling arms, missiles, and IT services to the military. And right now, the entire military sector has taken a little bit of a nosedive here coming into the first part of the year. And I think what you'll see with the Raytheon Company, it has a lot of ebbs and flows because it's all based on insider news about the next government contract or missile sale or whatever. But at the end of the day, it's a very strong company and it has done a ton of work for the government in the past, and it'll do a ton of work for the government in the future. But right now, we're in sort of a quiet period and some uncertainty in defense spending. And anytime you have a quiet period, people start asking questions, and that's exactly what's going on right now with not only Raytheon, but some of the others as well. But when you look at the company as a whole, and from a one-year chart perspective, it's been in the 225s as recently as about this time last year. And it's just sort of slowly ebbed and flowed down to $175. So right now at 175, you got a PE ratio of 1743. The forward PE is 1342. And the way I look at this company, and I put the bull case on here, the uncertainty around defense spending could be a good time to get this at maybe a solid, at least 20% discount. It's a great hold for the long term. You got a dividend of 2%, so it will pay at this level and every level below it, but it might be a good time to get in before the next wave of good news will likely send this stock over $200 easy. So get in now if you're interested. Number 2 on our list is the Cigna Corporation. The Cigna Corporation is a medical supplier. They're into pharmaceuticals, they have some devices, and they also recently merged with Express Scripts, which is a pharmaceutical provider. So Cigna is an established medical service that right now is just down from a very steep peak last year during the high tide of the market. Okay, so it's been well into the 220s and now it's trading at 165. And if you look at it from a fundamentals perspective, you got a PE today of 1565. The forward PE is below $9. It's at $8.91. And the reason that I put Cigna on this list is it's actually been in the news lately. They partnered with their recent acquisition Express Scripts, and they're putting together a new cap on insulin prices for diabetics. So that is, I think it was $25 for a 30-day supply of insulin. They've initiated this new cap on what they will charge people. So bringing the cost of insulin significantly down for diabetics across their network. So that's great news for the customer. And some people will say, well, that may not be great news for the stock because of profit margins. But the way I see it, if you already have Express Scripts, you're already developing the insulin, it's almost like a customer acquisition play, right? The more people they can get into their network by advertising these costs and being ahead of government regulation on insulin, then the better. And having Express Scripts there, which is already a pharmaceutical network that expands into many different channels, I think it's a good move. And I think, frankly, with Cigna Corporation, they've already demonstrated their highs in the past. They are not in their peak right now. So take a look at it. It's another dividend player, very small dividend of 0.03%, but it is there. And I just think that this is kind of an easy win for somebody who's just been beaten down a little bit over the past few weeks. Maybe you can get in on the next downturn in the market and save yet another 10 or 15%, but definitely put Cigna on your watch list. Number 3 on our list is Dropbox. Now, Dropbox, if you look at this chart, isn't as beaten down as the others. The real reason I added Dropbox to this list is simply because everything else that's based in a cloud or document storage space has gone up quite a bit for the year and certainly recovered from the December lows. So when I look at Dropbox, I see an opportunity of a stock that, frankly, outside of the December lows, has really just stayed par. And so it's been a laggard, so to speak, has not caught up to other market activity. Dropbox is coming in. They're going to be profitable for the first time this year. There is no PE ratio right now. The forward PE is expected to come in at $38.62. So really massive improvement there. And I know for a fact that Dropbox provides a valuable service. I've used it a couple times with companies that I've worked with. And so I think that there's a lot of growth here. It's a small company and it might be a slow grind with all the other more attractive, if you will, cloud plays. But if you don't mind getting a little smaller and doing your research, you'll see that Dropbox does have a lot of opportunity. So perhaps add it to your watch list. All right, number 4 on the list is TakeTwo Interactive, which is a video game developer. TakeTwo Interactive, like a lot of the video game industry, has been absolutely crushed since fall, and that can be a really good thing if you're bullish on the video game industry. I think it doesn't take a rocket scientist to go through that industry and understand that there's a lot of opportunities coming up. However, it is an industry that is in transition right now. TakeTwo Interactive is one of the stronger video game developers in terms of portfolio, business model. They have a lot of positives going for them. But as I put in my bull case here, Google and Apple recently launched plans to offer a cloud gaming service of some kind. And there's not a lot of details behind it, but it really spooked the market a little bit further in the video game industry and brought some of these developer prices down. I think that's temporary only because Google and Apple have some sort of video game cloud-based network, without attractive titles, they're really not going to get very far. And that's where TakeTwo Interactive comes into play. Nonetheless, you will need to research what Google and Apple are doing and form your own opinion on whether or not it'll affect the industry. I still see positives for the PlayStation, Xbox, Nintendo world, but of course do your own research. When you look at Take-Two from a fundamentals perspective, things are pretty good. You have a PE ratio of 29, which is somewhat high, I guess you could say, in the tech sector if you want to throw them in there. Forward PE of 19 isn't too bad. And you've got a chart where you see the possibilities for Take-Two range from last summer all the way up to 126, 127, and now we're down to 94.84. So simply returning to a version of last summer at some point gets you another $20, $25. There's no dividend with a stock like this, and what you're really waiting for here is the next title to come out under their name or the next fad in the industry. Take-Two does not have a big, gigantic title like you've heard about the Fortnites and stuff of the world. That's not on the plate right this second. However, those types of things can launch anytime in the third or fourth quarter and save the year or pump a lot of money into the fiscal year. So bottom line with Take-Two, take a look for yourself. And if you see some life in this industry, then it's definitely a stock that's on a downward spiral that might be a good play for a bounce back. All right, last on the list is Wyndham Hotels and Resorts, not to be confused with Wynn Hotels and Resorts. Wyndham owns a lot of the more affordable hotel brands across America, Quality Inn, Wyndham, Hotel 6, things like that, with significantly less expenses and prices than, let's just say, a Marriott or something of that nature. With Wyndham right now, there hasn't been necessarily a lot of positive news in the travel and hotel industry, so it's sort of been a little bit of a stagflation, if you will. Their peak came in May of last year, right above 60 some dollars. And then it came down, and it's been hovering in the $50 mark here for a little while. But one of the reasons I wanted to put them on this list is because we're about to hit travel season. In fact, we've already hit the first chapter of travel season, which is spring break. But then we're going to be looking ahead to, obviously, summer vacation for kids, all those things. And when I think about the possibilities for Wyndham from an earnings standpoint right now, with the economic uncertainty going on, I could see lower priced hotels becoming more popular for families as we're all trying to preserve some money and figure out which way is this market going, which way is this housing market going. I think if you're interested in the travel space, you take a look at Wyndham's recent earnings reports, go through there, see where the wins have been and what parts of the country they've been, and make a judge for yourself if you see enhanced traffic in the travel industry. I see a lot more car traffic and affordable vacationing, if you will. My personal take right now is Americans do have disposable income. They will be vacationing in the summer. I don't see a lot of holdback in the concept of vacationing and travel. I just think the forms of those travel and vacation trips will change. You could see a lot more highway traffic as people opt to drive instead of fly. And when it comes to hotel choices, whether it's Airbnb or things like Wyndham Hotels, I see Americans choosing for the less expensive options just to put a cap on their spending a little bit. So if you're looking for a travel play prior to the summer spending season, Wyndham might be a good one. Add it to your watch list, check out the fundamentals for yourself, and see if it's something that matches your investments. All right, guys, so those are 5 beaten down stocks to add to your watch list. I think all 5 provide some intriguing ideas for moving back up here in the short term. And all 5 really are pretty strong companies from a fundamental perspective. Not to say that things can't spiral out of control, but I'd feel good that all 5 of these are not going to fall off the tracks anytime soon. Let me know what you think in the comments, and I'll see you on the next video.